welcome out to the Tackle Trading Halftime Report. It is March 6, 2020. It's Friday, fun day, Friday Frank Day. We got myself, obviously we got Frank here, we got Coach Matt, Coach Mark. So let me jump right over to, man, this market gapped down quite a bit over the weekend. It moved down over the night, just continued to push. Like, I think it had like a slight rally at the close, and then that just died within like an hour. And then it's just ran down ever since that. Matt, what's your take on the market?
Yeah, I mean, the market's just simply, this entire week has been amazing. It truly has. Monday up big, Tuesday down big, Wednesday up big, Thursday down big, Friday obviously down big now. So it's just been an extremely volatile week. And like I said earlier in the week, it really does remind me of that European debt, type situation where, the market in 2011 didn't know how to price in, because the market will price in good news, it will price in bad news. What creates this volatile situation where you have massive ups and massive downs on any random day is the uncertainty of the news cycle and the uncertainty of what's happening. And so very similar to 2011, when the market was having a very difficult time pricing in the European debt problem, they're having a very difficult time pricing in the economic impact to what's happening from a corona perspective, because everybody expects the economy to slow. There's two major themes going on. Number one is the supply side economics coming out of China, and that's obviously a concern. And I think even a possible bigger concern for the market is how consumer behavior, consumer spending, retail sales, those types of situations, because the consumers have really helped drive this market. And how is their behavior going to change given this ever-changing condition that we're seeing on a day-to-day basis with the corona scare? So to me, it's having a very difficult time pricing in this, and the Fed is not helping in any capacity. I mean, my goodness, guys, if you look at the Fed funds future, and mind you, we just had a emergency 0.5% basis point cut. And when you look at the Fed fund futures here, guys, just later on in March, we are pricing in a 62% probability. By the way, that was 58 just like 30 minutes ago. We're pricing in a 62% probability of a 0.75 basis cut reduction. And there's nobody that doesn't feel the Fed won't cut. You're also pricing in about a 37% probability of a 0.5 basis point cut. Guys, I said it earlier this week, the Fed's going to zero. I thought it would be over the next year. My God, it might be over the next 2-3 months, guys. Fed going to zero.
Nuts. If they cut again this in the coming weeks, and it's that dramatic,
no, it's not.
That's going to cause more.
Yeah,
it seems like more panic than it will help. They need to seriously rethink that.
How many times does everybody have to tell the Fed rate cuts don't cure illness, and it doesn't cure consumer behaviors? So they could they could go to a negative interest rate impact, but that's not going to change consumer behavior if the fear of the corona is going to expand within the US, and we're starting to see it.
Yeah, consumers have no idea what the Fed's even there for, how their rates even affect anything. After the surprise cut, I said something just, to some of my employees, and I was like, man, the Fed cut half a point, and they're like, who? And I was just like, yeah, consumers don't even have a clue. They're worried about their own health, their own safety. They're not going outside. They're not going shopping. It's like, how does the Fed literally think? Like, they must be in a bubble thinking that everyone knows what they're doing.
Well, it's the definition of insanity. Just kind of do the same thing over and over. And this time it will matter.
No, it won't.
You're saying it won't, huh?
No, you're right. People, Main Street America, they don't understand interest rate policies. They don't understand they don't even know who the central bank is, right? They just know that when they go to the bank and they try to get a mortgage, whatever the interest rate they're paying, they don't understand that they're paying 4 banks, not 1 bank. So yeah, whatever the Fed does here, it's not going to cure the supply side economic problem, and it's not going to cure the consumer behavior problem. And that's why what the Fed does is just causing more of the problem. They're causing more of if the Fed doesn't cut rates and they say, okay, everything's still fine, we're not seeing it, it wouldn't cause the massive economic upheaval. The Fed's really kind of asleep at the wheel right now.
Yeah, I feel that way as well. I think you're spot on.
Absolutely. Well, sorry about that. Had some loud motorcycle drive by me. Did y'all hear that?
Trying to get away from Corona.
No, it's one person who lives in the neighborhood. They do it every day. Normally when I hear them coming, I mute myself. But
You know, it is fascinating to see kind of this market from a technical perspective over the last 24 hours, though. When you came into the market and you kind of double topped here at that 3,100 level, that last little ramp that we had on Wednesday, the last hour kind of broke through that 3,100 level. But right when the market closed, you've had a very consistent, and this is probably the most consistent intraday trend I've seen in the last throughout the past week. Is you've had this very consistent, nice little trend just on the downside. And right here, you're forming another support level. I mean, you got ticks down at about 29.10. You got a base right there at about 29.20. So if you puncture through that, I mean, it's not 2,900. It's lower than that. And day traders are just loving this market environment.
Hey, Matt, will you put that on an hourly chart for me real quick? There you go.
Where is my 1 hour?
Right there.
Oh, yeah.
I just interested in that 20 hourly moving average, which is a significant bellwether for these type of trends. I mean, we saw that it came out on the tick a couple hours ago and just get slapped down.
That was the cash open.
Yeah, came up to the tick, algos slapped it down, and obviously there's not real bullish sentiment. There's not real euphoria for that type of price action to occur. So, for potential reversals here, I mean, we do have a support level that is formed just north of 2,900. But like we were talking yesterday, having that 20 hourly come down, having that support level form will form a compression pattern. And a lot of times when you see reversals, it clears that 20 hourly. And that could be a really, really good signal at a potential reversal.
Oh, I guarantee the traders are getting ready to buy above 29.75, right?
That really stands out.
You have an old support here. It was also support last on Tuesday. That's where the resistance is. That's where that falling 20 period moving average is. I guarantee the traders are getting ready above 29.70 or 29.75.
Short sellers would look to potentially cover, and you see
that's where their stop losses are. Absolutely.
You see,
but the exact same thing can be said on the downside too, Mark, where they're also preparing if we do break this support level on an intraday. I think the next couple hours are going to be very telling for this market coming into the weekend.
Yeah, we're in an interesting spot. Sooner or later, something's going to have to give. Although there's not a lot of time left in the day, maybe we can just stay compressing all day long.
Stay compressing down 2%. It certainly could. It certainly could.
Doesn't seem the most likely thing, does it?
Well, let me just ask you guys the question, right? Are you guys looking to carry anything through the weekend?
Nope.
No. Is it called
outside of gold?
Is it called gold? No. I've been, I've agreed with you guys and your analysis throughout the week and the places I've seen you where this really is a day trader type of market. And like Keith has told you, Matt, why fight with, the randomness of the news that can come out when we're getting pretty good swings on these intraday setups. So I can't imagine what I would want to hold over the weekend that wasn't, like Mark said, gold.
Yeah, just the gold as a hedge, maybe a short on oil. We definitely got to get into that. Oil has a tremendous amount of news, but it's going to be fascinating to watch this market over the next couple hours coming into the close. And I do think it will be telling about how Wall Street feels about this coming into the weekend.
So
right?
Going to the close is going to be an important hour.
I want to ask Maddie
whether they're selling or buying.
I got a question for you, Maddie. So if you had to bet, do you think it's more likely, and just a fun question, I guess, that we break resistance, seize the short covering, kind of like we saw, to some extent, at least last Friday? Do you think that's more likely that happens, or more likely that we give out the support? If you had to bet right now.
If I had to bet right now, I would bet we come in strong to the close.
That's where my head is too.
I think the people that have been shorting the market over the last 2 days, they're going to be pulling off their shorts. Obviously, you have to buy that back, and so I could see some short covering here to basically see the markets going up. I'm also seeing some technical changes here. You got a rounding bottom here that and then obviously a very positive cash open that we saw in the morning. Most of the pain that we saw in the market today happened on the overnight action. It really hasn't done much since the end of the day. So I would say gun to head, Frankie, Yeah, I'd say short covering has a fairly strong close, maybe back up into that 3,000 level. Now, I would only put that maybe at 55%.
Yes, would be betting the mortgage
Right.
on it.
I wouldn't be no, I wouldn't be betting the mortgage on it. But I think that would be the most likely scenario here.
So I would
definitely
agree.
see that.
That's where my head would be. What about you, Mark? I'm just curious because I don't know if I'll talk to you guys after the show or not. So.
It's a thing I talked about in on Saturday, and it's been an ongoing theme that I've created. Like for the next level down of panic, I really think you need to see that next escalation of the Corona story. We didn't see that this week. We saw the situation gradually get worse, fears heighten. But like when South Korea happened 2 weeks ago, you saw this massive, gigantic, huge surge in cases. Now we have seen and let me preface this.
Also because South Korea was testing, Mark.
I know this. You have started to see in Europe really massive increases statistically. The one that has me, I mean, you see countries such as Germany pop from almost nothing to 500 now by the end of the week. And this is a real tipping point because we remember when cases in Italy or South Korea hit 500. And then you started seeing huge statistical jumps from there. We see Belgium, their cases rose double overnight from 50 to 109. So you're seeing Europe start to have really broad-based increases in the number of cases where it's obvious by this point that it's throughout Europe at this point. But it's not enough for it to be present. That's what market participants already know. We already know that the coronavirus is in different places of the world. But where's that freak out headline where people say this is really bad in Germany?
It's when the US starts testing.
You know?
That's when, because I think we can all agree that in every country this is happening, from China to Japan to South Korea to Iran to Italy to Germany. Every country, we've seen it slowly build, but once they start testing, you see massive spikes in the actual confirmed cases. And the US, for one reason or the other, I mean, we're not going to get into the political fray there, but we have not tested the same way that other countries have. So where's that headline? It's when it spikes from 200 confirmed cases to 2,000 confirmed cases, because I think the one thing we can all agree on is more people have the coronavirus than what we think.
Well, that's great. And then you also see headlines because you have a large segment of the U.S. population that rejects mainstream media, and with good reason. Mainstream media doesn't have a stellar track record of being unbiased. So I get that.
Is that the kindest way you could put it?
You know, so yes, that was very diplomatic way of doing it. But and people don't trust governments necessarily, no matter who's in power. And so you have this real split right now in sentiment where you have a lot of Americans say this is crap. A lot of Americans say, no, we need to be very cautious. But kind of that like tie-breaking vote for me is the World Health Organization. You know, that doesn't have any desire. You know, and a few hours ago, the Director General of the World Health Organization warned governments that the coronavirus spread is not a drill, and it said significant action would be required to contain the outbreak. And so the World Health Organization, I think a lot of people in trying to analyze what is going on objectively, fairly, not from the mainstream media who might be stoking fears, not from governments who are trying to suppress fears. So you have these two sides trying to do perhaps their best for whatever reason to create different sides. I think the World Health Organization, more and more people are looking at as their source of information on how to determine what is the real state of fear in governments? What is the real state of fear?
So what you're saying is we should listen to people that don't have an incentive of bias one way or the other.
That do not have an agenda. And I mean, because the World Health Organization hasn't exactly been this panicky organization. I don't even believe they've called it a pandemic yet. So they're not, and so they haven't even labeled it a pandemic yet. But when you hear them say that this is not a drill, and that and what the key phrase there is that significant action would be required to contain the outbreak. And that for me is key, because in areas where we have seen countries try to contain the outbreak. China numbers are not near. I mean, nobody sees the China headline numbers anymore because there's nothing to see there. Few cases added to the total, but they have done amazing things to contain. South Korea is an example of a country that is trying to contain the outbreak. And so I think what spooks market participants such as myself, when I put all this together, I'm like, all right, so when you contain the outbreak, there is statistical success. Cases go down, deaths go down, the rate in increase goes.
We've seen that in China, Mark.
And we're starting to see that in South Korea. South Korea, in those early days, had these huge, gigantic statistical jumps. Now, do they add a few hundred cases a day? Yes, but they climb from 6,200 to 6,600. Normal rates that you would say, yeah, of course you're going to add new cases, but you're not seeing these huge, massive statistical jumps. That
aren't we seeing a contraction in China?
Yeah, we are.
You're never going to.
Actually, I think yesterday was the first day that it finally turned over.
Confirmed cases
off, I think it actually turned over where yesterday or Monday it was like 35, and then now it was like 30 or 29 or something like that today. So it is starting to like turn over just slightly, but it did flatline first.
That is a positive sign, though.
That is a positive sign.
And so you have, I mean, we're developing this blueprint in how to deal with this, but the only places it works is when containment of the outbreak becomes a priority to the society, to the governments, to the people. Everywhere else, and this is what spooks me, everywhere else, the spread is really, really fast. Czech Republic health minister a couple hours ago, is saying, European Commission, be more active when it comes to containing it, because we're starting to get a really good blueprint.
That's I agree with you, and I think everybody agrees with you, Mark. But
because that's like
to truly contain this, though, you're going to have to risk certain industries, certain sectors, certain economic factors. You have to put in the back burner, and are we going to do that? I don't know.
And that's the thing. Some societies will say yes. Some countries will say yes, and others will be cavalier and that it's just the flu, and they won't do the measures necessarily to contain it on the level where we've seen success. Now, on the great news, I mean, China and South Korea are showing us, yes, is there tremendous economic disruption? Without a doubt. I don't think there's any way around that one way or another. I mean, that's just
it's just a matter of how deep does it go.
But does your society, does your country want to prioritize this, take a short-term economic hit? And that's very encouraging when, hey, yes, the coronavirus is not going to be the plague. When countries do this, it contains it, alters lifestyle, alters consumer behavior, but it's not going to end the society.
But I think what you said is very, very, very wise, Mark. Economically, if you do these draconian measures to control this situation, it's a short-term economic hit and not a long-term economic hit.
Like a backburn to control wildfires, where the fires will go out there and they'll backburn sections before the big flame hits it, so it dies out. And yeah, that's what it is. Or I get reminded. Did y'all ever see the video? There was like a fire sweeping through a farmer's crop, and he took his tractor and just basically cut down half his crop right in front of the fire. And it's like a smart thing to do.
Because you risked economics to secure the position, right?
Exactly.
Yeah, so I completely get that. But I've talked to a lot of traders, really, really, really good veteran traders, 20, 30, 35, 40 years into the market, the Keith Kings, the Pete Thomases of the world. And the question I've asked them, in our conversations is, what would it take for you to get bullish again? Because almost everybody I know has a net negative delta right now. So what would it take you to get bullish again and push those chips into the middle of the table and start buying these stocks again? Because the U.S. economy outside of the coronavirus, I mean, guys, we added 273,000 new jobs. Unemployment this month went down from 3.6% to 3.5%. PMI service number yesterday was a positive at 57%. So economically, even with the corona, the data we're seeing is still pretty fundamentally I don't want to say it's glowingly amazing, but it's fairly strong. So in terms of this, what would it take you to push those chips into the middle? And none of them said Fed lowering interest rates. All of them said they needed to see more transparency and they needed to see more positive situations coming out of the corona. And this week has just been chock full of just random news regarding that.
And to be honest, to everyone listening to the halftime report out there, and why you should listen to the halftime report every trading day you possibly can the rest of your trading career, is because the world class type analysis that you were given here on the halftime report that mirrors exactly what was said 3 weeks ago, 4 weeks ago, 5 weeks ago, before all of this started. We've been really, really on this situation, and it is not a pat our own backs, but it is a stick around with us over the years, stick around with us over the months. You'll get good advice even in calm, nice, great times.
Oh yeah.
We really care about being as objective and analytical as possible, and we will continue to give that to you here on the halftime report and to our other products as pro members.
I try to catch the halftime report every day. Some days I can't make it till later, but I'm usually lurking in the comments because even when I'm not around, I know there's things to steal from you guys. So I appreciate it.
Well, in terms of that analysis, let's move on to the dollar index here. Cody, I want to get your take on this. You're going to be doing the Forex report.
You wanted me to shut me up, so I didn't talk anymore. Let's go. How do you shut Mark up? Start talking about the dollar.
Well, hey, listen, really quick. That was really good stuff, Mark. But all I asked is, with their little intraday play above resistance on that breakout,
and it's that entire conversation. But that's the way things work over here.
Absolutely.
But on the dollar, Matt, we're seeing another huge drop, not only because of the cuts that we had, but because of what you were just talking about. The Fed is looking to cut rates again, and when you see these projections from the CME watch tool, Fed watch tool, that they're going to cut, and it's not a debate of like, okay, are they going to stay the same? It's a debate of how much are they going to cut. That's when you start seeing money flood out of the dollar. So even though you have the dollar, the Swiss franc, and the Japanese yen being your reserve currencies, so in times of fear, people are usually moving into these currencies. When you have the U.S. Federal Reserve decreasing rates, that's fundamentally devaluing the dollar. So why would you be throwing money into the dollar as a reserve asset when you know that it's going to decrease in value if the Fed cuts rates again? So we're seeing another huge leg down.
To me, it's not even a debate at this point. I think the Fed has lost all credibility, but whatever credibility they had. I said on Twitter yesterday, Swin, a great follow on Twitter, he posted about something about the Fed's credibility, and I said, at what point has the Fed had credibility since Volcker? And the Fed's response to this has just been laughable. But when you're talking about an emergency 0.5 basis point cut, and now the probability is another 0.5 to 0.75 basis point cut, guys, the Fed's going to lie through their teeth about this. But they're going to go to zero interest rate policy. They're going to do a further quantitative easing. The Fed's balance sheet has increased by over 150 billion just this week alone. And when you do those environments, the dollar is going to go down in value. It's going to happen. The 2-year note hit a record low yesterday. The 10-year note hit a record low yesterday. The 30-year note hit a record low yesterday. 30-year mortgages hit a record low yesterday, and that's going to continue to go down. If you're looking to refinance your house, just wait a year. You're going to get a better rate. But the reality is, when the Fed does these types of situations and they massively are trying to increase the liquidity of the dollar within an economic system, markets are going to price that in. And that's what's happening today. And that's what's been happening over the last 2 weeks, as the market is constantly pricing in what they know about the Fed. And what they know about the Fed is in the face of anything negative over the last 12 years in the market, the Fed has one tool, and they lower interest rates. And when I was talking to Keith the other day, and Keith's going to be on the Coaches Show next week, and I'm going to bring him on the halftime report next week as well. When I was talking to Keith King a couple of days ago, Keith asked me a question. He said, Matt, do you think we will see negative interest rates for the first time in our history? And it took me about 5 seconds because I had to think about it. But my answer was yes. I do believe that we at some point in the next year and a half, maybe 2 years, will see a negative interest rate environment for the first time in U.S. history. Very similar to what the Eurozone, Japan, Swiss franc is doing. 15 out of the top 20 currencies have some degree of negative interest rates.
and it's absolutely crazy. I despise modern monetary theory, but you know what? I can't change it, so I just have to learn how to trade.
You just have to apply it. You just have to apply it.
It's not
Moving
my
on very quickly, the news of the day for me anyways is crude oil
I was
here.
going to say, speaking of things dropping rapidly,
I mean, just Russia. OPEC was meeting, ministers were meeting yesterday and today. They were preparing for a 1 to 1.5 million barrel reduction. That's what Saudi Arabia has been proposing. And Russia said no. But Mark, not only did they say no, they also did not extend the current 1.5 to 2 million barrel cut that was ending at the end of March. So they didn't come to a deal for further cuts. They didn't extend their current cuts. Obviously, crude oil is taking it on the chin, down close to 8% today. Mark, what's your read here from a fundamental perspective on crude oil?
Well, I mean, there's a couple interesting things. I mean, it's like Russia. It's very curious to why Russia would do that. It's almost like this brazen, ideological, screw you. It's like they're living in a bubble to how their actions would result in price. This is the equivalent of if the Fed came out and said, no, we're not going to cut rates. In fact, we might raise rates. We don't give a crap what's going on.
Markets would tank.
The markets would react negatively, especially on that day, because, on that day, there would be a huge price shock. And that's the equivalent of what happened with oil and OPEC and Russia's stance. Russia is probably along the lines of like conservative individuals in this country who are saying the coronavirus isn't bad, it's not going to be bad. That's obviously their take on it. Like they're dismissing the impact of coronavirus on oil demand, because I can't think of another logical reason why they would take that action if they weren't dismissive of the coronavirus and its impact, saying, no, long term, nothing to see here. Maybe they're right? Maybe Russia is ahead of the game here, right? Saying, no, we're not going to make these massive changes because of short-term price fluctuation. And so it, to me, says Russia is dismissing the coronavirus, and one could say they're right, one could say they're wrong, but they are dismissing it. And one of the ongoing, for 4 or 5 years, central premises of oil stability, it's been the one I've cited numerous times, is that one of the things that one can remain bullish on oil for, feel good about cash flowing it at cyclical lows, is that you had an OPEC plus that was on board with making sure that the supply-demand equation was balanced. That for at least one day, who knows what happens tomorrow, who knows what happens, right? Maybe Russia's negotiating something here. Maybe Russia is like, we're going to make this stance, but what we really are is trying to get concessions so our oil output isn't as low. Maybe that's part of their strategic plan. But at least for one day, that narrative has been shattered. It's been shattered.
Do you think the debate happening between OPEC and Saudi Arabia and the OPEC non-exporting countries revolves around who's going to actually do the cuts? Well, could that be the negotiation?
Russia, and go back, and once again, like when you study the rhetoric over the years, Russia is always the last to the table on oil cuts. They're always the last to, all right, they're the last person that people are waiting for when you're trying to project whether another cut or another level will be reached. They're always the last one at the table. They're always the most hesitant. Putin recently said, hey, we're comfortable with oil at this level. Once again, is that reality or is that negotiation posturing? It's a very, there's, when you analyze,
even if that's negotiating, even if that is negotiating, just techniques here, Mark, it's still going to have a very significant short-term movement in the price action. We confirmed that retracement the other day. It broke the intraday support levels yesterday, and obviously, on the news overnight when we didn't get any positive news out of Vienna, oil just absolutely tanked because oil, I mean, if you want to talk about the global economy, it starts with oil. It doesn't start with the S&P 500. And obviously what we've seen out of the airlines and travel and cruise industry, I mean, just absolutely devastating impacts to the airline industry, to the cruise industry. You're seeing that also in oil. Frank, from a technical perspective, you're technically, your nickname at Tap and Trade is Breakout Frank.
Yeah,
right?
it is.
Where you love trading on breakouts and breakdowns here. We're obviously violating, if you remove the fundamental concern that Mark was talking about, which was spot on. But if you remove that and you just focus solely on the technical situation here, you are violating this support level, Frank. And when a market does break support, what does it have a tendency to do, Frankie?
It has a tendency to drop, and that tendency can be pretty darn quick. This is a pretty significant, in my estimation at least, support zone. Obviously short term on the daily, but look where we are on that weekly chart. You know, that is a big zone, and I don't know exactly what we call it. Do we call it 42? Do we call it 40? One of the things with crude, we get a lot of that, right? Where, you know, we get a lot of, it's more of a zone than a very, very specific number.
It's a massive zone though, isn't it, Frank? Like,
it's a big zone.
I think if you weren't trading on the overnight and taking that intraday breakdown, I don't think you can chase it here because you're right within that zone of support. No. I mean, obviously you're at 42.20. You do have support at 42. I think that number is $40 though. I think if you break down that $40 barrel, guys, there's not anything until you get to the to the mid 20s, maybe 30.
Maybe $30 zone.
And so I could certainly see a scenario over the next week where, you know, the oil traders and the big dog investors try to keep it above that 40 handle, because if it does violate that 40 handle, everybody's going to run for the woodworks. I do think there's a shorting opportunity there.
Oh, I believe so. And when it comes to breaks, you know, breakouts or breakdowns, the one thing I think you want to do is everybody looks and says that broke, you know, and so somebody might say it today, someone more aggressive than me. And while I wouldn't, but now I'm going to go buy this thing, I wouldn't be there. So I would agree with your 40 analysis. Now, if I'm in a bear play on crude right now, I'm probably, as opposed to, you know, fundamentally locking in the profits, I'm not opposed to dragging the stop down a little bit because it is a zone, you know, and it is a zone. The caveat there would be, I'd got to be willing to sit through at least a little bit of a retracement, because that technical crowd that does like to buy off of support, I maybe should look at it more, because I, you know, get to those support levels, I wait for a break and get it, or I don't. But there's a lot of people who like to buy at support, right? And I respect them. That's why I like the breakout so much, as well. They get their chance. If it fails, well, why are they buying it when it breaks the support, right? That's, you know, my whole logic behind liking breakouts so much.
And I don't think people are buying crude. I think they're just stopped shorting it, you know, at this point, and they're just kind of fading. I mean, you're really forming a little bit of a low base type situation right there, right underneath the 42 handle, obviously the low right there at 41.77. I could see aggressive traders shorting underneath that low and with the target of 40. But if you're looking for anything from a swing trade position, I think you got to wait to let it set up again and perhaps a breakdown of 40, because if OPEC doesn't cut, regardless of the corona situation, whether you know it gets contained or whether it doesn't, the problem still exists. It's going to take a while for consumers to feel confident to take their family on a vacation, to take their family on a cruise, to get on an airline. It's going to take corporations some time to get conferences going and travel going. I mean, literally just yesterday, you know, tech companies out of Silicon Valley are sending their people home. So it's going to take time for the economic engine to really start getting going again. And so if OPEC isn't going to cut to save the day, my opinion is watch out below here.
Yeah, I think you nailed it.
And I had a question that comes up, because whenever things get beat up, value investors, the only thing they think about, boomerang style traders, is, all right, when is the opportunity? Because you know eventually there will be one. Once again, the coronavirus, when you analytically look at it, the coronavirus is not going to wipe out humanity. It could get bad. It could get worse before it gets better. But there's at some point an end to this based on what we know. And trying to predict when that's going to happen. Well,
my personal opinion, and this is just pure opinion, I don't even think it's going to get as bad as H1N1 from 12 years ago. But the fear out there is real. regardless of the corona situation, any speculation, any data, any numbers, the fear out there is real and it's expanding. So it's just going to take time for the consumers to come back in these types of industries. But at some point, there's going to be a really good buying opportunity in oil. And at some point, there's going to be a really good buying opportunity in the airlines. And at some point, there's going to be a really good buying opportunity in these industries that have been just massively just kicked in the teeth. These casinos, these airlines, these cruise lines, and oil itself. But that point is not today, in my opinion.
No, and will be over. I mean, not only do I think there's going to be a good opportunity in oil, once again, oil's in the front lines of all this mess. If the coronavirus lingers for months and months, and more importantly, the fears and the alteration of travel and people working from home, oil's going to get it kicked in the teeth, and trying to guess the bottom is anybody's guess. But not only do I think there is going to be an opportunity in oil down the road, there is going to be a non-cash flow opportunity where, oh my gosh, screw covered calls. I'm going for price appreciation.
Yeah, you're going for growth.
You're going for growth. And that doesn't happen very often in commodities in my world, but you're like, no, this is too good of an opportunity. I'm not getting called out. I'm going for pure growth and have some of those like mega trades that kind of make a person's whole year.
I agree, but again, let's let the bottom kind of form.
Like trying to guess when that's going to happen. You need to be really, really patient on that.
I mean, you still have that falling knife on MGM. You still have that falling knife on Wynn Resorts. You still have that falling knife on Las Vegas Sands. But at some point, there is going to be an opportunity from an investment perspective, because I don't think any of these companies are declaring bankruptcy here, right? And I also think the government's going to have a little bit of a say in terms of stimulus packages at some point in the future. And so, like you go back to 2008, and when the bottom was coming out of everything, at some point the government came in with massive fiscal stimuluses, and the central bank came in with massive monetary stimuluses. And at some point, I do see that playing out here as well. But we're still in the middle of it. We got to be patient about that, because we just haven't seen that in the charts yet. Seeing those bottoms, seeing those slowing momentum, seeing that double bottom type scenario. So stay tuned. Maybe it's a week, maybe it's a month, maybe it's 3 months from now. We don't know that timing, obviously, but at some point, I do think there's going to be a really, really good buying opportunity, both in terms of the market as well in terms of some of these industries that have been depressed. And obviously, that's what the oil is well. But if you look back to the last time that they were not cutting oil and we were seeing slowing growth in the market, Saudi Arabia was basically declaring war on the frackers. The economy slowed down in that environment. Oil went down to $26 a barrel. Could that happen again? Maybe. But from a price action, we're starting to see that.
Yeah, the thing about bottoms is you don't actually have to get in literally at the bottom. You can wait for your signals. There's still a lot of upside. If this were magically the bottom, there's still a lot of upside if we wait for that development, right? We don't have to literally pick the bottom number. That's
exactly but I could definitely see hedge funds and institutions coming in as oil's going down to 40, 35, 30, saying, you know what, yeah, we'll take a little bit of risk to the downside here because we're going to hold it for the next 3 years. And I'll just ask you guys, 3 years from now, okay, don't you think oil's going to be pricing at $60 at some point?
Yeah.
Well, I would have until you said the hedge funds were going to buy it. Now I want to bet against them.
But hedge funds also, when they take a position like that, they don't have the emotion that individual traders do. They're taking that position knowing that eventually one day it's going to go up, and they're putting millions and millions, if not billions of dollars into purchasing these things, and they're just going to let it sit. So you think about what they're going to do versus what a trader should do. Yeah, we should wait for the reversal and get in and miss out on the games. Trying to pick the exact bottom, let them.
No, that's a fool's game.
Yeah, let them do that.
I don't even believe that they do that, but that's another story for another day.
That's a fool's game. But the reality is, it's always about your time horizon, right? If you're swing trading, you're looking at shorting oil, you're looking at adding 2 positions, you're looking at trailing stop losses, you're targeting 40, a break of 40, you're targeting 35, a break of 35. You have these short-term technical type situations. But again, at some point, I just do believe that in these depressed areas of the market that have been hit the hardest, if the corona scare is overblown, and like, you know, Cody believes that 3 months from now, we're going to look back and say it was a scare, but it wasn't, you know, as bad as it could have been, then we're going to start to see the consumer behavior change. We're going to start to see corporate behavior change. We're going to see fiscal stimuluses. We're going to see monetary stimuluses. We're already seeing that out of the central bank. And at that point, you're going to have a buying opportunity, but that point is not today.
Agreed.
Absolutely.
Mark, gold. Volatile day today. I saw a question earlier today, earlier, I can't remember who asked it. Why is gold not running?
The need for human beings to apply price action in commodities to any given day is, I understand it. You have to break free from day-to-day price movement, or else you'll make bad decisions in commodities consistently. You don't have to go back more than a week looking at the sell-off that occurred in gold last week to understand that. Like, the charts in gold are never going to be as pretty as a consistent trend in a stock. When Visa is uptrending, when MasterCard is uptrending, when Microsoft, when these trends occur in stocks, they're so orderly as a general rule. Pullbacks are orderly, daily price action is orderly. Yeah, there might be a blip here or there, but to understand the movement and the technical beauty of a stock chart in an uptrend, or the violent beauty in a consistent downtrend like you've seen in the intraday chart in equities, that's very consistent and very normal in equities. Day-to-day price action, and you can go back and study gold, day-to-day price action is rarely as smooth as moving in commodities as it is in the world of equities. And so trying to say, well, I think this should be running, you have to take a longer perspective and a longer picture with gold. It's why at the start of 2019,
Mark, I'm thinking about gold 5 years from now, not 5 minutes from now.
And that's why at the start of 2019, and if you go back to a weekly chart and highlight the price action at the start of 2019, when we were screaming, literally, sometimes me, because I like to scream. Ask Cody whenever he brings up Trump if I like to scream.
It is true.
Like screaming, like it's great, the perspective, the everything, because gold and commodities as a general rule, sometimes there's beautiful little day-to-day movements, but that is the exception rather than the rule. Most of the time in commodities, you have broad movements that occur, broad trends that occur, that when you back out to larger time frames are a little bit easier to see. When you have extended candles that like have occurred in gold in the last 3 weeks, this is particularly true. Look at the size of candles on gold as a general rule on a weekly basis that we're looking at here. Like they're small, they're orderly. Whenever you have massive candles where the trading range expands out dramatically, this gives algorithms, day traders more of a window. And we've seen that in equities, how that big, broad window of expanded trading ranges can cause chaotic price behavior. So on gold, I would warrant, like, day-to-day price action is irrelevant in our analysis of gold. It's fundamentally driven. We look at longer time frames. We look at those dips like we saw last week as opportunity. I know whenever you buy anything, you want it to shoot to the moon today because you're a human being, right? But like trying to understand daily price movement in gold is not the same. You have to take a step back.
I think the analysis is very, very simple. If we're right on the central bank, you should own gold and not care about day-to-day fluctuations.
Is that it? I mean,
Agreed, 100%.
Is that simple?
Yeah,
it's just do that is buy the physical, and then you just get to look at how nice and shiny it is, and you know that you're not going to go sell that thing tomorrow. So,
and if you do buy physical metals, please do not store them in your house in an economic environment like this.
Good advice.
just
carry around my pocket.
Just recommending it. A couple individual stock news here very quickly, guys, and then I'll kind of turn it over to just kind of final thoughts here.
I have to say one last thing on gold. I'm against physical ownership of gold. I'm a paper asset gold guy because you can't cash flow and hedge and do different things with that gold sitting on your bedroom floor that you can with paper.
You're right. But if we go through hyperinflation at any point in the next 20 years, you're going to want to own the physical.
Well,
So
but I don't believe any of that will happen, which is why I'm not for physical ownership. So,
but you can swim in it like Scrooge McDuck.
yeah.
Come on now.
I think the argument for physical gold ownership goes back hundreds and hundreds and hundreds of years if you understand currencies and currency devaluations and central bank action. So we can have that debate on the podcast. So Boeing here, news of the day coming out of Boeing. The House investigation finds Boeing was marred. Shocking news of the day. We said this 18 months ago. Shocking news of the day was marred by technical problems and a complete lack of transparency. Obviously, Boeing is not a company that we would want to touch here. Jobs report came out.
Is there a shorting opportunity on Boeing?
I said there's a shorting opportunity at 340. So yes, there is a shorting opportunity here.
I continue to keep Boeing off my list altogether with its nonsense.
It's very, very news driven and opinion driven. And I don't disagree with what Frank says. Starbucks here, also a couple individual stock news. Starbucks, we all knew Starbucks and their importance of China and so on and so forth. Mark, we've seen this with Chinese economic data in the last month. We've seen automobile sales just plummet. We've seen shoe sales plummet. We've seen housing purchases plummet. We're talking 80 to 90% decreased in economic activity. Starbucks sales plunged 78% within China. That's just another thing we're going to be seeing, and this is going to have a longer-term economic impact. And the last stock of the day, and then I'm going to let you guys have your final thoughts, is Costco. Oh my goodness! Everybody's shopping at Costco. Everybody's buying all the toilet paper, all the water, all the canned goods. Everybody's buying everything.
All the hand soap. That was one that got
hand sanitizer. And you know what?
Soap being bought out makes me wonder, like, were people not washing their hands before?
That is an interesting. That is an interesting point.
I have plenty of hand soap, but I was in Walmart the other day and I saw that there were only 6 hand soaps on the shelf left, and I just bought 2 of them because I'm like, there's not many left, and there's the consumer is like, well, I might as well buy a couple. Like, there's not any left, and so there's this self-fulfilling prophecy.
Apparently, Corona is good for Costco sales because their EPS number came in at 210 versus the expectation at 207. They saw 39.1 billion in revenue versus the 38.3 billion expectation. So a beat on EPS numbers, a beat on revenue numbers. Revenue grew at 10.4% year over year, which was also a positive. Obviously, the market is having a hard time pricing, but Costco has held up in a lot of this volatility. Keep an eye on Costco here. Now we'll see if they can continue to keep things on those shelves for all of us consumers to keep on buying everything Costco does have. Frank, final thoughts here.
Yeah, well, I want to address what Jack said because I've heard it a lot. I've thought about it a lot. And he just said, thinking about airlines, thinking that they're depressed, they're beat up. We all know that. Some of them pay nice dividends. Delta is the one that Jack's referring to. I've been thinking that too. ExxonMobil is like an 8% dividend yield right now, or very, very close.
They better increase that
to that. And so these things are starting to come into my mind, and I'm sure into not just Jack's, but I'm pretty sure everybody's. The names, the industries, they may change, but I think the thought process is there. From my perspective, we still got to wait from some settling. I don't want to do a covered call, on Exxon when it had a 7% dividend yield a few weeks ago and watch it, continue to tank, and into the saying, I would apply that same analysis to anything, regardless of what it was. So should those, I believe we should be putting together our list of, these are the things I do want to buy for.
What are those companies that we're going to buy that got slaughtered if Corona doesn't play out to the worst case?
Exactly. Yeah. Let's get that list put together. But personally, I still think we've got to get some signals. I think we need to see, at the very least, the signals on the individual company, as well as some shrinking candles on the broad market. While these candles are so big, I don't want to deal with that volatility. So I do think it's a good idea to put these watch lists together, and we have some time to do so. Personally, I believe it's too early, no matter how tempting the price might look. And believe me, I get it. I've seen a few that I was thinking, yeah, man, but you
I was
still
going to say
got to
that 45 handle on Southwest is enticing, but it's still a falling knife. You are starting to see some slowing momentum though in those candles. When you look at Delta here, you're starting to see, the volatility come out, and the projections, our airline industry could, lose up to $118 billion in revenue. American Airlines here, you're just seeing an absolute falling knife. So, United Airlines also canceling flights within the U.S. They're the only airline in the United States to really kind of cut flights. But you're going to probably see Southwest cut flights. You're probably going to see Delta cut flights. You're probably going to see American cut flights as well. Out of those airlines, though, the two that do kind of stand out to me from a technical perspective would be Delta Airlines. Maybe a slowing momentum. Maybe it gets back above 50. Maybe there's a play there. Southwest, sitting on a very, very important support level right there at 45. Maybe there's an opportunity there as well. But I'm going to need a few weeks before of data. Before I do that, because a 3.5% dividend isn't going to cancel out a 20% drop in price.
Well, and if you made me guess, I would guess the airlines aren't done selling. Personally,
no,
that's not how I want to trade, but I would bet on that side of things. Maybe an interesting idea for a pairs trade where long Delta, short UAL or something. I don't know.
Long Delta, short UAL. I've never thought about a pairs trade in the airline industry, but based on what I'm seeing in the chart, maybe I can sign up. But same thing, you can say the same thing with the casinos. You're sitting at multi-year lows on Wynn Resorts, MGM. As you're obviously at multi-year lows of support there at $20. Las Vegas Sands, you're standing at multi-year lows right there, about $50 to $55. So yeah, there's going to be an opportunity in these sectors that really got beat up. But guys, we're still at the very front of this. And anybody who says they know exactly what's going to happen 3 months from now from a Corona perspective or an economic perspective, I think that's pure speculation. Now, some speculation is better than others, but I still think that is pure speculation. We need to see it in the data.
Agreed. Over in the clubhouse today, Robert McGee had a fun question. I see what he was trying to do. He asked, could you make a bullish case? And he had a bunch of airlines and cruise ships, and then he snuck Splunk into it. The software company, SPLK, snuck them into it. I was like, one stands out as different than the others. So
which one was it?
SPLK.
Oh, Splunk.
So they're a software company, just came out with some earnings, but I thought it was a fun question to answer.
Well, it's going to be a debate amongst a lot of investors over the next 6 months about these depressed type companies. At what point do you get back in? I think we got to see Wall Street get back in.
Absolutely.
And you'll see that in volume, and you'll see that will be reflected in price action as well. Mark, final thoughts from you.
I understand the desire for value investors to start to speculate when to come in. Basically, piggybacking off what Frank says, 4 areas that I am not even tempted by right now are transportation, which includes oil and its relation.
UPS, FedEx, airlines,
social gathering stocks, basically stocks that require large amounts of people to come together. Cruise ships comes to mind. You're going to see societal behavior change in the short term. And because I'm not going to pretend to be hubris and say, this isn't bad, or this isn't, a horrible situation, or this isn't, I'm going to pretend that I don't know. But I do know that if it continues, social gathering type stocks are going to get hit. Third area that I'm not interested in right now are consumer behavior retail stocks such as Macy's, Gap, Starbucks, things that would require people to actually go visit the stores.
Brick and mortar.
Brick and mortar type stuff. And fourth, banks. There's a growing negative sentiment out there right now that if this thing gets bad and the economics are bad, you can have a lot of businesses default. You have lower interest rate environment that isn't theoretically good for banks. So if I'm going to speculate, and I absolutely understand the temptation to start selling those, especially with naked puts out on the money on companies that I love that don't fit this criteria, I'm going to avoid these areas. I'm going to look for other stocks in other areas that before, if I'm going to do anything, which I personally not, but I get it, and I don't exactly even disagree with it.
I don't think we're there yet. But
if you are going to do it, because no matter what people say, you're going to do what you're going to do, right? Look at areas of the market that if the coronavirus fear spreads out and consumer behavior changes because of it, look at areas that aren't directly impacted by that consumer behavior shift.
You said two things that I think are important. Number one, you said you expressed concern about the banks. In a lowering interest rate environment, banks are not going to be as profitable as they are in a higher interest rate environment. That is a concern. You also just saw today the fourth biggest bank in India fell. So I need to do a little bit of research into that, but I saw that come across the headline today. That's obviously going to be a little bit of concerning. Banks out of Europe are Deutsche Bank itself is going to be upside down. They're massively over leveraged. 2 years, I don't know what the current leverage rate of Deutsche Bank is, but 2 years ago it was like 70-1. They had $1 trillion in the bank and they had $70 trillion in loans. And when you go through some of these environments, those banks are going to really, really struggle. And if we do see something nasty economically, just remember back to 08, guys, whereas the S&P 500 went down, 57%, those banks got absolutely destroyed to the point we're needing, billions upon billions upon billions of dollars in bailouts. The second thing you mentioned was the value investors. At what point do the value investors come in and say, this is a really good opportunity? I just want to remind everybody that one of the number one factors in a value investor is price to earnings ratio. And right now you're looking at the P ratio of the marketplace, and we are still extremely, extremely overvalued from a value perspective. So are there going to be opportunities in those areas of the market? Yes, but again, I mean, we're still overvalued. I mean, the Shiller PE ratio, which is the number one gauge of assessing S&P 500 valuation, the Shiller PE ratio today is still at 28. That is still, even at 28, that is still the third highest overvalued market from a PE ratio in the history of the modern markets, only surpassed by Black Tuesday in 1929 and only surpassed by the dot-com at the height of the euphoria of 1999. So are the value investors looking at this market crisis and saying, hey, listen, I'm willing to pay a 30 P ratio for Facebook, or I'm willing to pay a 30 P ratio for Microsoft, or I'm willing to pay an 83 P ratio for Amazon, or a 23 P ratio for Apple? I think the value investors are still on the sidelines kind of waiting. Maybe the Warren Buffetts come in and buy some of these depressed, taking on some of the risk in the short term for a longer term. Yeah, I understand that logic, but in terms of the valuations here, I don't see the argument from a value perspective.
And Matt, just one last little thing on that. Plus, we don't know the economic impact that will even alter those valuations even further. I mean, that's with good, robust data, right? That's like.
Yeah. It's easy to forget how early we are in this because we've seen a lot of selling, but it's easy to forget that
we're only
this is
two.
early.
This is the second
This
week.
is 2 weeks in. It seems like a longer time.
Well, it does, but we're only 2 weeks, and it just remember when the trade war first hit, guys. It was really, really volatile at first. People didn't understand it. They didn't understand what the administration was doing. They didn't understand the economic impact. They didn't understand China's response to it. It was really, really volatile, but at some point it became a normal market. And even in the craziness of 2008, 2009, where the market plummeted 57%, there were really good buying opportunities in certain industries and sectors as the market was going down, because it's about what finds support sooner. Right? Utilities will recover faster than technology stocks, right? Food-based companies will recover faster than, bank stocks will, for example. So, we're going to, be doing that analysis. And obviously we got the Scouting Report meeting coming up here in just 2.5 hours from now. And you know what? We're going to rank those sectors and we're going to rank those industries. And we're going to, based on our rankings, you kind of will see exactly where our thought process is from, a sector rotation perspective.
Going to be fun. Looking forward to it. I always look forward to it. I love those meetings.
Absolutely.
they are entertaining. That is for certain.
They are they are.
They are entertaining. A bunch of cutthroat traders analyzing the market without a filter. It's a really, really enjoyable time.
It can get heated a few times. It's fun. It's good stuff.
Sure. Enjoyable. I would question the use of that word in all situations, but
see, I don't have the same. I'm a little more mellow than Mark, maybe. So I can see why he doesn't know that they're enjoyable. Yeah, so is basically everybody.
But it's. I think it's important though. We used to invite like students to come and sit and watch us analyze, but I just never felt like it was the raw,
Right.
data.
Yeah, you didn't want to.
It wasn't the same. Yeah, it
Wanted to
wasn't.
filter yourself a little bit.
Everybody put on their teaching hat and their teaching voice, and it's just like, oh, I want raw. I want your opinion. I want your detail. I want your data. And sometimes, when you're dealing with people that have had a lot of success from a trading perspective, an investing perspective, been around the markets for years and decades, yeah, it's sometimes it can be heated, but again, I honestly think that's good that we have those heated discussions instead of everybody just saying, yeah, we agree with everybody, because it allows us to really kind of work out, our opinions on the marketplace, because not all of us see everything. Not all of us, do everything. Not all of us are around the market every single second of every single day. So I think it's important to have that rawness to the market, though.
Absolutely. Absolutely. Love it.
All right. Well, my final thoughts are, guys, public service announcement. Wash your hands. Wash your hands before you eat. Wash your hands when you leave the bathroom, regardless of what you did in there, whether you're picking your face or using the restroom. Wash your hands. Wash your hands before you eat. Get your flu vaccine, because that's something else people want to talk about coronavirus. Is how do you know if it's the flu or coronavirus? Well, if you have a flu vaccine, you know it's not the flu.
You told me a shocking stat that only like 42% of the population gets their flu shot.
I think that was of adults, and yeah, that's absolutely shocking. Now, I'm
going to get my flu shot.
I'm okay with some people would be like, okay, well, I'm a young, healthy adult in my 20s, and I don't go out much, and okay, I'll take that argument. But people who have kids, people who teach, work in industry around people, it's like they need to get their flu shot, guys. So go get your flu shot, wash your hands.
Wash your hands and
that's well.
And I have one last. I just got Kaysville, which is a community here in Utah. Their police department just issued a statement saying, "Will you people please stop stealing the toilet paper out of the local restrooms? We are experiencing a crisis."
Oh my God, that's funny.
Seriously, it just came across an hour.
Hey, that's why you don't order gold in your home.
Stop stealing toilet paper from the local community restrooms.
Oh, that's just
all right, guys. Well, as always, if you enjoy what we do over here at Tackle Trading, you enjoyed this show, make sure you give us a like and a share. We've been having record high attendance at halftime report, so we do appreciate all of you that have been coming in to join, to get our opinions and our analysis on the market. So make sure you like it, make sure you share it. And if you want to become a member of Tackle Trading, make sure you click the link down in the description. It gets you set up for a 15-day free trial, or you can always email Mark at team@tackletrading.com, and he'll be set up.
And this is a perfect time because, guys, I'm telling you right now, I've said it all week long. Get excited. Keith is going to be teaching futures trading, hedging, day trading, using futures as just teaching the futures market in general over the next month, the next 4 weeks in the Tuesday night coaches show. Get excited, guys. So if you want to learn how to trade futures, you're going to learn from one of the best out there.
You are going to learn from one of the best. I'm excited to hear what Keith has to say for sure.
Every time somebody asks me, "Hey Matt, can you teach us day trading?" I'm like, "Go to Keith. He taught me."
I know he's the man. There's no doubt about it.
He does things that I don't understand, and I'm gonna tell you, maybe I'm promoting it as much because I'm geeked out, because I'm excited to be there just to learn.
Oh yeah, absolutely. Yeah, me too. Absolutely. It's going to be fun.
And then Matt, tomorrow I do my commodities report live every weekend, noon Eastern. There will be a link up in the calendar. We're going to go over some day trading techniques that we use in commodities, some basic, real base stuff for people that have never day traded before. Go over for the next few commodity reports, start talking about some fundamental principles, because we talk about day trading so often the last 2 weeks, don't we?
Yeah, Gino calls me up 2 days ago and he says, Coach Gino over there at Tackle, he says, "Matt, why is Mark's commodity report like an hour and a half?" I'm like, "Because it's a class." It's that, I mean, and he's like, "Well, why does he do it like that?" I'm like, "Well, the truth is Mark just doesn't know how to use Camtasia and record videos, so he just does it live. but it's turned out to be something really, really, really cool that you go live and people are attending, can ask questions. And I love what you're doing with the commodity report, Mark. Keep it up. No doubt about that. Guys, get ready for our scouting reports. Obviously, we're going to have our reports, our newsletters out over the weekend. So use those as a barometer for coming into the market as your weekly prep. We have daily prep, guys, that's going through your daily routine. You got weekly prep, and it starts with the scouting reports and the newsletter, preparing for the week coming up in the marketplace. So get excited for that as well. And with that, guys, we are out.
Have a great weekend, everybody.